en bonne voie. Given the various uncertainties that we face, the bank is particularly data dependent at this time. However, that doesn't mean that monetary policy will react to every data fluctuation. A better way to think of this is that it takes hundreds of data points to make a complete picture, and each new one helps the picture come into sharper focus. So when a data point comes in differently than what the bank or other forecasters expect, it matters to the big picture, but it's almost never decisive on its own. Now, as we've previously discussed, an important issue we face is to understand how the economy reacts to higher interest rates, given the high debt loads being carried by Canadian households. We're monitoring this situation very closely. We've seen a moderation in credit growth, and the debt-to-income ratio has begun to edge lower. At the same time, the housing market is also dealing with the revised B20 lending guideline, and the data don't yet permit a sharp distinction between the impact of the guideline and the effects of higher interest rates. Governing Council did take some comfort from an analysis of the renewal process for 5-year mortgages taken out in 2014 and 2015, which are up for renewal in 2019 and 2020. Now, this analysis shows a very modest increase in debt service ratios compared with the date of origination. N'oublions pas que beaucoup de ménages ont vu leurs revenus augmenter ces 5 dernières années, et ils ont pu s'habituer à des revenus plus élevés. Ils pourraient devoir s'ajuster quand le ratio du service de la dette va remonter. Cela aurait un effet sur les dépenses de consommation. Of course, this issue is most important for highly indebted households. We also know that the jump in payments will be greatest for those who took out mortgages when interest rates were at their lowest levels. That's in 2015 and 2016. So the mortgage renewal process is likely to weigh on the economy more in 2020 and 2021. All that said, Governing Council concluded that the economy should be resilient to higher interest rates, provided that labor income continues to grow. In our discussions, the biggest issue on the table was trade tensions. Comme nous l'avons déjà indiqué, l'incertitude entourant l'avenir de l'alignat a amené certaines entreprises à retarder leurs dépenses d'investissement ou à déplacer leurs investissements vers les États-Unis. Nous avions entrevu cette possibilité et nous l'avions intégrée à notre projection il y a un certain temps. The recent imposition by the U.S. government of actual tariffs on Canadian exports has made the situation more concrete. In the projections we're presenting today, we've added more negative judgment to our business investment forecast in recognition of this. We've also incorporated the effects of the U.S. tariffs on steel and aluminum and the various countermeasures implemented around the world. Box 2 in the NPR gives a flavor of the complex effects such actions will have. So let me summarize briefly. A U.S. company importing Canadian steel must now pay a 25% tariff. They may instead buy steel made in the U.S. or in some other country. Or, if no obvious substitutes are available, they may just pay the higher price. Or, the Canadian company may offer to reduce its price in order to absorb some of the tariff's impact. Or, it may look to other markets to sell its products. La réaction des entreprises va dépendre de la période durant laquelle elles pensent que les droits de douane vont rester en place. Par exemple, il semble que si on réussit à renégocier l'alignat, ces droits de douane vont disparaître. Ce qu'il faut retenir, c'est que le résultat dépend des réactions de chacun, et ces réactions dépendent des circonstances. And then there are the countermeasures. Canada has imposed a 25% tariff on steel imported from the U.S. Now, this would seem to level the playing field, but many of the same complexities enter the analysis. All things considered, our analysis suggests that Canadian exports would fall, as would Canadian imports. Prices would rise at a time when the economy is already operating at capacity. So inflation would rise at least temporarily, but the effect could persist. Consumers would have less purchasing power, so demand would slow. Meanwhile, the potential of the economy would be eroded as companies invest less and become less competitive. So the economy would see shocks to both demand and to supply, resulting in two-sided risks to the future of inflation. Furthermore, the net effect on the economy might be buffered by any fiscal actions that governments might take. Now, as we said in the NPR, these various effects are likely to be small for the measures that have already been taken. In contrast, a large tariff on Canadian-made automobiles and parts would have a much greater effect on trade and the economy through these same channels. People are understandably concerned about this sort of escalation and want to know how monetary policy might react to it. Indeed, there was speculation that the bank wouldn't move interest rates today because of the possibility of further trade measures. But the bank cannot make policy on the basis of hypothetical scenarios. We felt it appropriate to set aside this risk and make policy on the basis of what has been announced. Given the multiple channels through which protectionist measures affect economies, it should be clear that monetary policy is ill-suited to counteract all of their effects. It may, of course, play a supporting role in conjunction with other policies. But to put it bluntly, the economy would slow, inflation would rise, and the exchange rate would depreciate, adding further to near-term price pressures in the Canadian economy. Therefore, the implications for interest rates of an escalation in trade actions would depend on the circumstances. Je tiens à le souligner. À elle seule, la politique monétaire ne pourrait pas réparer les dommages à long terme qu'une montée du protectionnisme pourrait causer à l'emploi et aux revenus. Cela dit, il ne faut pas oublier que notre économie est en bonne santé. Elle tourne presque à plein régime. Les entreprises investissent, même si certaines hésitent. Le marché du travail est vigoureux et surtout l'inflation est à la cible. It's important to remember that our economy is in a good place. We're operating near capacity. Companies are investing, even if some are hesitating. The labor market has been strong, and most importantly, inflation is on target. In this context, higher interest rates will be warranted to keep inflation near target. Governing Council will continue to take a gradual approach to adjusting rates guided by incoming data. On a more personal note, I'd like to take this opportunity to thank Deputy Governor Sylvain Leduc for his service to Canada. Sylvain is headed back to San Francisco, and this is his last week at the bank. He was a great member of our team, and we wish him and his family well. The process of choosing a new Deputy Governor will be launched this week, led by our Board of Directors. And with that, Senior Deputy Governor Wilkins and I will be happy to answer your questions.
Great, thank you, Governor. So we'll get started on the questions. We'll have one and a quick follow-up so we can get around everyone in the first round. Again, just remind you, please push the microphone until the light turns green. First up I have on my list is Andrea Hopkins from Thomson Reuters.
Yes, thank you. I'm wondering your comment about, or the statements about housing in both the NPR and in your statement. Is it a good thing that housing appears to be stabilizing, in your view? And resales possibly recovering?
Well, we consider it, yes, it's a positive thing. I mean, we, as we've said multiple times in the past, one of the things that we'll be careful of is to mindful of those vulnerabilities so that a monetary policy doesn't inadvertently prompt the very risks that we've been monitoring. So watching the housing market adjust to both higher interest rates and to the new B20 guidelines is an important preoccupation for us. So we understand how it is evolving, and the fact that it's stabilizing suggests that we had a reasonable understanding from the beginning about how much the effects would be. But of course, it was a bit of an unknown for us because it was new territory, and in particular, the B20 guidelines. You know, that's We analyzed it a lot at the micro level to understand how it would affect things. But as we said at the time, many of these issues go down to the individual level. People who don't qualify for a mortgage on the house they wish today have a multiple avenues of adjustment. One of them being to just go ahead but buy a smaller or less expensive home. So how it all turns out will be one of those issues of data dependence. And so we're quite happy to see it stabilizing, yes.
And then you mentioned what some of the markets might have expected. I'm wondering if you could give us your thoughts on what you think the biggest misunderstanding is between what your message is and what seems to be out there in terms of what people expect.
I'm not really seeing any misunderstandings, Andrea. I think that the market has been watching the data very closely as we have, and today's adjustment was certainly highly anticipated. I think that's just an example of how data dependence should look. So yeah, I really don't have anything to add to that. I don't think there is an issue.
OK. La prochaine, on va aller à Mylène Crête, à la presse canadienne.
Bonjour. J'aimerais savoir si vous pourriez me dire jusqu'à quel point la robustesse de l'économie canadienne la protège de l'impact négatif des tarifs américains et si vous pourriez être précis dans votre réponse. Par exemple, quel facteur économique protège?
Oui, ben c'est certainement un facteur. C'est préférable d'avoir une économie robuste quand il y a des chocs, par exemple des chocs comme les tarifs, parce que les effets sur la confiance sont pas vraiment prévisibles. L'analyse sera la même pour un économiste dans une économie faible ou une économie forte. En effet, c'est un ceteris paribus situation. Mais en même temps, ça ne compte pas les effets de la confiance. Si la confiance est déjà faible, on s'attendra à des effets plus larges, probablement, un effet de multiplier dans un contexte. Alors, c'est l'avantage d'avoir une économie aujourd'hui qui est robuste avec ces chocs. Oui.
Et dans l'encadré numéro 2, vous faites allusion à des mesures de soutien du gouvernement qui pourraient atténuer éventuellement l'impact négatif. Est-ce que vous avez en tête des mesures supplémentaires que celles qui ont déjà été annoncées?
Non, j'ai pas en tête des actions supplémentaires, juste des choses qui ont déjà mentionnées. Peux-tu élaborer?
Oui, le gouvernement a annoncé qu'ils avaient mis jusqu'à 2 milliards de dollars disponibles pour les entreprises et les ménages dans les secteurs qui sont touchés par les droits de douane. Alors, c'est de ça qu'on préfère.
Merci.
And next on my list, I've got Greg Quinn from Bloomberg.
Good morning. Are we still at a point now where kind of the end game is an economy that still needs a little bit of stimulus to fend off headwinds?
I don't think we know the answer to that yet. It's a question of, as we've said before, our confidence in the outlook grows a step at a time. And it's why we've emphasized so much that we're data dependent, because there are unknowns such as what it will be the sensitivity of the economy to a given level of interest rates. We have estimated it to be larger in our updated model, and provided box 3 as an additional elaboration and to help us monitor how it's actually going. And we're also unsure how much additional investment will happen to expand Canada's capacity. So those are a couple of key issues that affect the answer endogenously, if you like. That just depends on how things turn out. And so that's why we've always said that this process needed to be one done in real time, that you would monitor those things as you went along. We have reviewed, as of April, our work on the so-called neutral rate, which we still believe is in that sort of 2.5% to 3.5% zone with inflation at 2%. So that's why we say, that given everything else, how well the economy is doing, it's evident to us that higher interest rates will be warranted. But of course, we're not in a position to say exactly how much higher or at what rate we might get there.
Secondly, on wages, again, you mentioned that wages are maybe moving a little slower than you might expect. Why is that happening, and how important is it to your assessment of what you do with interest rates from here?
Well, that we look at wages very closely because they're a good indication of how well the labor market's doing and also how much capacity there might be left. And of course, with our underlying wage growth of being at 2.3% right now, that's a bit slower than one would expect with a labor market at full capacity. So in our assessment, even though in the BOSS, our Business Outlook survey, we're hearing there are pressures, labor shortages in certain sectors, and that's growing, there still must be areas of labor market shortage. Now, of course, this isn't something that's unique to Canada. Other countries, including the United States, are looking at wage growth really closely, and there's a lot of research going on trying to tease out why that might be. There's a few hypotheses that are out there that seem to be viable. For example, there's lots of older people who are retiring, so you're replacing people that were at the high end of the pay scale with those who are just entering the labor market. There's the issue of just so much competition in the labor market coming from foreign sources of labor, but also digitalization and other kinds of automation. And then finally, there's some work that looks at, are companies having more power in terms of labor markets than they would have in the past to control wages? And so those are all things we're looking at. There's no one single answer for Canada, but it's certainly on our list of things that we're monitoring.
I've got Kevin Gallagher from CTV next.
Good morning. Can you take us through in the projections for the impact of U.S. tariffs on the Canadian economy? There's a projection that the impact is going to be possibly worse than original projections. And so can you just say, with the projections that you made with your report, why do you feel that it's appropriate to raise the interest rate this much?
All right, so I'll just start that, but you can walk in a couple of those details. But to begin with, what we're talking about are separate things. I think there's several things that are entering into that analysis. So to begin with, for a year now, we've had growing uncertainty about the future of Nafta, more than a year, actually. And that uncertainty has been weighing on decisions of companies to invest. I mean, if you were concerned that Nafta might be torn up, as was advertised, then would you expand your business at this time with say a 5-year horizon in your business decision? So in the exporting sector, companies have been telling us, we're putting off those decisions. In some cases where they have cross-border operations, they're expanding in the United States because it's less risky at this time, et cetera. So we've identified that through our BOSS and have inserted it into our models. So we've been carrying that, and what I said in my opening remarks is that given the actual implementation of concrete tariffs, which are part of this process, that makes that seem even more real than before, and so people are talking about it more and more worried than before, and so we believe that uncertainty effect will be larger than what we had in the April exercise. But Carolyn, maybe you just take the rest of the steps and walk through how we get to the cumulative effect on our outlook and what it means, please.
Sure. So of course, the governor just talked about our judgment with respect to just how much uncertainty is affecting investment decisions as well as exports. But we had concrete measures, and so those tariffs that are imposed on aluminum and steel are going to have an effect on the level of exports of about 0.6%, and that's meaningful. Now, at the same time, when you look at that, you have to take it for what it's worth and understand how we need to be data dependent, because as the governor said in his opening statement, companies have ways to adjust, and we just don't know what their behaviors are going to be, whether they'll find new trading partners, new suppliers, maybe absorb some of the cost if they think they can for a while. And so we'll be looking at those data really, really carefully. Now, it not only affects exports, it also affects, in those particular areas, it also affects kind of ancillary sectors. And potentially plans to invest and Canadian workers' incomes. And so all that needs to be factored into the rest of the projection. On top of that, we had to take into account the Canadian countermeasures. Those are going to affect imports coming into Canada about the same amount, partly by design, as the exports. And so we've taken that into account. Now, that's an offset to the exports. And the final thing, which I think people tend to forget, is just how it affects the purchasing power. Those countermeasures and the other inflationary effects affect the purchasing power of consumers. They're going to have less income and less ability to consume. We've taken that into account. So when you add that up, including all the other tariffs we've had before, including softwood lumber, you get to quite a meaningful reduction in the level of GDP of 0.2% that is just lost. And that's quite a bit of income that has been lost to Canadians. Now, of course, as I said, it's something that we're going to have to monitor. And part of your question was, well, then, given all that, how can you have enough growth in the economy to warrant raising interest rates? And that was answered in the governor's opening statement. But one part of that is just to think about our export and investment profiles, which are a big contribution to growth over the forecast period. When it comes to exports, we've been surprised so far this year, and so that higher level of exports is something that we've already seen, and certainly our forecast with respect to growth going forward is very prudent. We think the risks around that are balanced. The same with investment. You have to think that for exports, there is a floor to it. I mean, the economy in the U.S. is doing very well, stronger than we thought, and oil prices are higher than they were in April, and so there is a floor to this, and we are confident in our outlook given the assumptions that we've made so far.
I guess my follow would be, there seems to be still a lot of uncertainty around that. So how much of the decision to raise interest rates now is about those projections you just talked about, and how much of it is a response to an anticipated hike in the U.S. Federal Reserve rates?
All of it on Part A and none of it on Part B. So that's the simplest answer to your question. But I think it's important to think of this, the downside risk that people are identifying around trade is very important. We treat it very seriously. But as I mentioned in my opening remarks, a lot of that could evaporate if Nafta is successfully renegotiated, over the course of the summer or fall. That to me is a very important positive risk that we shouldn't lose sight of. And so as a policymaker, we can't just go around making policy on the basis of hypotheticals on one side of the spectrum. We need to base our decisions on what we actually know and putting those things that we know into our models and using them to create that forward-looking view. And so despite the 2/3 of 1 percentage point of GDP that we estimate will have been lost by 2020 by the cumulative effect of all these actions, we're still, we believe, operating at about 2% growth, which is slightly above potential, and operating at capacity, with inflation already, at target. So those are your basic ingredients, which suggest that interest rates cannot continue to be excessively stimulative. So we're reducing the amount of stimulus today.
Okay, next up I've got Yali Nadai from Market News International.
I was wondering if this time around in your discussions, you raised the issue of a recession of stagflation more than you did earlier this year, given that we are seeing that some of the risks related to protectionism are getting materialized now.
So certainly the negative trade scenario, if I can call it that, the escalation of trade actions was quite a part of our discussions, but we agreed very early on that it was not going to be the basis for our decision, but it's something we need to keep ourselves well informed on. And it's why I carefully laid out the channels in my opening remarks, because I want people to understand just how complicated that type of shock is for the economy. Similar to the oil price shock of 2014-15, and yet a layer more difficult or more challenging. And therefore, in a sense, from a monetary policy standpoint, doubly complicated. And, the basic thrust of it is that given what we'd expect to see, that inflation would be rising while the economy was slowing. Like you suggest, a classic stagflationary type of, that's one of the possible outcomes. It's probably the one that we immediately think of. And that, of course, puts monetary policy in a difficult place. But we know what our objectives are. We know what our target is. And it's the clarity around that which gives people confidence to make their decisions in the economy. And so it would not be an occasion for us to somehow change, what was guiding policy. But if you had a significant trade action which led to a sizable Canadian dollar depreciation, rising prices for therefore two reasons, would be about scale. Like when we had the oil price shock, we had, of course, rising inflation because the Canadian dollar took a lot of the adjusting then too. But we were able to scope it out immediately, explain to people how much inflation would rise by, for how long, and that it would be temporary, and therefore we felt we could credibly see through it and act in such a way to buffer some of the negative effects on the economy and speed up its adjustment process. Those same considerations would come into play in an adverse trade scenario, but as I just said, they would be even more complicated. And so it's just not clear what's the optimal thing for policy to do. But it could hinge on just how big of an inflation bulge happens, like how important the tariffs are to the inflation process. If the economy is operating at capacity, it can cause a shift up in inflation expectations, and that's something that we would vigorously prevent.
I also was wondering if today do you feel more confident today of the need to raise rates than you were at your last meeting?
You mean our last meeting in May?
Yeah.
Or in April? In May. In May, the very last meeting. Okay. Well, yeah, I think so. I think our confidence has grown through time. And again, it's not an easy thing to set aside all that, all the talk around trade because it sounds very threatening. But as I said, there's the other possibility that it all gets fixed up. And so setting that aside, yes. I mean, for example, when we believed that Q1 would be a slow quarter, and our question was, well, okay, would that be carried through, or would we get the rebound? And so we've been heartened to see, stronger investment in exports. So our indicators are suggesting we had that right, and then we got the 1.3 for Q1 exactly right, which really bolsters your confidence. suggests that your models are doing it right and your people understand well what you're facing. So I would say, as a judgment, my judgment, I think Carolyn would agree, our confidence has grown in the last 6 weeks. Yeah.
All right, thank you. Next up, I have Kevin Carmichael from the National Post.
Good morning. Lots of chatter out in the international markets about flattening yield curves, inverted yield curves. Would either of you like to comment on what you're seeing in the bond markets?
Yes, in the last couple of months, we've had quite a bit of compression in the long end. I've had a lot of conversations around that with market participants, and the most likely explanation, it seems to me, is that the appetite for long-dated product is absolutely huge, and we're in an environment where there's a lot of uncertainty in equity markets. If you look at equity markets on the surface haven't done too badly, but the performance is highly concentrated in a small number of investments. So a lot of stocks are down. Anyone that's exposed to international trade has proved to be quite vulnerable. So as a pension fund or a major investor, long-dated bonds look like a good place to go. And so the issues get snapped up, vastly oversubscribed, and so the central banks, are just beginning now to get out of the bond buying game, and so that whole thing, I think, is up for discussion as we go forward. I guess that's a long way of saying that I don't interpret the flattening of the yield curve as a warning sign, as we would perhaps in more conventional times, because it's often said that the bond market is the smartest forecaster that there is, and I happen to think that's probably true. But at the moment, it seems to be dominated by an incredibly strong appetite for a long product.
And my follow-up, not unrelated, but not exactly related, but it has to do with your outlook for the U.S. economy. I noted in the risk section at the end of the NPR, you cite the risk of a stronger U.S. growth. You do that at the same time. There's commentary out there, of course, that we're on the verge of the next recession already. So, could you speak about your outlook, your confidence in your outlook for the U.S. economy, and what you see happening there?
So as you might have noted, we've upgraded, at least in the near term, the outlook for the U.S. economy, and a large part of that is just the data that we've seen. And so it's not something that's carried forward in growth space in the future. What's happening there is maybe the materialization of a risk that we've carried for a number of NPRs, which is the ignition of animal spirits in the U.S. I mean, clearly the U.S. tax reform and whatever else is going on there has ignited activity, and that's being reflected in a lot of the data that you see. There is that view out there that recessions come because expansions die of old age. I don't happen to subscribe to that. Recessions happen for a reason. Sometimes it's triggered by monetary policy. Sometimes it's triggered by some outside event. That's certainly not our base case. So we have quite strong foreign demand, which is something that is supporting the Canadian economy. That's not to say that some of the uncertainty that we're seeing on the trade space isn't affecting the U.S. economy. We have some negative judgment on our outlook for the U.S. as well as the globe to take that into account. We're hearing some stories, some anecdotes from people that we talk to, businesses that are saying that even in the U.S. There's some hesitation coming from that, but it's certainly not enough to offset what is a very strong outlook and stronger than what we estimate their potential output growth to be.
Thank you. So we've just got a few minutes left, and luckily I have two people left on my list. So I've got Luke Kawa from Bloomberg, followed by Kim McCrell from the Wall Street Journal.
Hi, Governor. So in the past, you've kind of spoken about a divergence story between the U.S. and Canada, and also the idea of Canada being like 2 years behind the U.S. in the cycle. However, in terms of short rate over the past year, it's been a story of complete convergence. You've hiked just as much as the Fed over the past 12 months. Markets expect that to carry over for the next 12 months. Given where you stand and the estimates of kind of tailwinds from the fiscal side for the U.S. Versus ebbing tailwinds in Canada on that front, do you find that kind of market outlook appropriate?
Well, I wake up every morning thinking that the market is almost certainly right. Let's begin with that. I'm never going to get into an argument with the market, but I think it's just important for us to remember that this is not a simple mechanical process. It's a very judgmental one. We've emphasized over and over again the data dependence of what we're doing, and the issues that we're looking at are the sorts of issues that could cause our gradual pace to be sped up or to slow down. Either of those is quite possible, and right now we're just waiting for the data to continue to confirm that our beliefs are well founded, and as that happens, then as again I said, our confidence will continue to grow. So I don't think there's no tying up of those things at all in our minds. Theirs will be what theirs is, and ours will be what ours is. I think that's it. Do you want to add anything?
The only thing I would say is that clearly what happens in the U.S., if they're tightening because the economy is strong, and that's having an effect on the yield curve, certainly we'll take that into account in our forecast, but that's the extent of the relationship.
And then kind of just on the consumption rebound story, I'm wondering how much of it is linked to this idea that we're going to continue to draw people back in the labor force and have rising LFPR, as well as have wages pick up, because we're basically at pre-crisis norms for working age and prime age in LFPR headline, and kind of wage growth has stalled out recently, as you noted. So how dependent is that rebound on those factors?
Sure. The rebound in consumption in part is just a bit mechanics, because it was a bit weak in April because of the ice storm. So there's a little bit of that just bounce because of that. After that, in our forecast, the consumption's really being held up by income growth. So strong income growth, and that's coming from stronger wage growth and a little bit stronger hours worked. We have a little bit coming back in the part rate, but that's not what's driving it. I would just note, just as a fact, that in the most recent labor force, there was a tick up in the part rate, which is always nice to see, even though those data are very volatile.
And certainly, if we look into the disentangle effects in consumption, we can see pretty clearly where the interest-sensitive components are reacting as our models predicted they would, and the ones that aren't interest-sensitive are behaving according to the model, and then there's some in the middle. So again, the data, if you abstract from ice storms, which I prefer to, the data have held up quite well according to our outlook. So there's nothing there to make us question that judgment.
Thank you. And so the last questions go to you, Kim McCarroll from Wall Street Journal.
Thank you. I wanted to turn to auto tariffs. In your statement this morning, you said, in speaking about protectionism, that the economy would slow, inflation would rise, the exchange rate would depreciate. Is that a comment on the possibility of auto tariffs specifically, or on rising protectionism?
Yeah, I was speaking in generic terms about a significant trade action. This is how we would model it. Those are the channels that we would need to look to. They're not that easy to pull out of the steel and aluminum tariffs, because they have quite a small effect. As Carolyn was walking through that, 0.6% on exports, minus 0.6% on imports, minus 0.6 in exports as well. We're both down. 0.1 perhaps on GDP and 0.1 on inflation. You know, those of course, we can't leave those as zeros, but they're really small numbers, right? But I think even though the auto sector, auto and parts, auto sector assembly and parts represents on the order of 1% of GDP. So quite a bit larger than, and of course, complex supply chains that are cross-border, very hard to do all the modeling around all that. But I think when we talk, even though it's only, say, even then you'd say, well, it's 1% of the economy. That's, you know, not that big, but I think it sounds small, but it's 100% of the economy for the affected families, right? It's 100% or a big percentage of a local economy. You know, just like with steel and aluminum, it could be a relatively small town, which so it has a lot of jobs lost potentially. And so it matters from that point of view. And it's also, I think, very symbolic, because I think putting in place the tariffs on something as, you know, sort of the auto sector is like motherhood and apple pie or something to the Canadian and U.S. economies. I mean, we were agreeing on how to organize auto trade, you know, just after I was born. This is a long history of collaboration in this sector to great benefit to both economies. So if you're willing to do something to disrupt all of that, I think people would naturally feel much more vulnerable. They would feel like, well, what's next? And there'd be a major confidence effect. So I think symbolically, it would have a very outsized effect on the economy compared to the size of it in the actual arithmetic.
Thank you. And can I ask you also just to comment on the how far could the Bank of Canada go in trying to counteract or to deal with tariffs on the auto sector if they were to come into
Right. So well, as I described it, you know, the short version is that the economy slows down because, well, for obvious reasons. The economy slows down, but inflation picks up quite significantly, both because, you know, 25% on cars and so on would affect inflation directly. Any model that I know of would predict that the exchange rate would begin to adjust in order to try to buffer that shock to the economy, just as the oil shock did. So the exchange rate would depreciate. So for two reasons, inflation would be rising at the same time that the economy is slowing. And as I said in my opening remarks, that puts monetary policy in a very awkward place. But again, the predominance would be, well, the last thing you can have happen is have inflation expectations begin to be revised upwards. So we would need to take all that into account and see what room to maneuver there might be to help buffer the economy. But as I said, the inflation part would probably dominate that analysis. But I can't prejudge it. It would be a highly data dependent thing. And as just with today's actions, there are multiple paths of adjustment for companies. And so it would all depend on all of those adjustments, how it would turn out. It's not a thing that you would conduct in theory. It would be in real time. Want to add anything?
I just want to underscore what you said in the opening statement, which is that it's with potential outcomes like this or scenarios like this that you need to understand what monetary policy can do and what it can't. And so with an outcome like tariffs on the auto sector, which is a largely structural change, we need to look to other policies to fix that problem or to address that problem, because monetary policy just isn't suited to do that, and it shouldn't be. It doesn't mean it's not powerless. In fact, monetary policy still has a lot of power to do its job, which is to target inflation. And I think it really comes at these times when we think, well, how important is that? And it's just fundamental when an economy gets buffeted by major structural changes, that the one thing you can be sure about is the solidity of your macro fundamentals. And inflation control is just at the base. We take it a little bit for granted because we've had it for so long, but you just need to look to other countries or other times in Canada's history to see just how useful it is today.
Thank you. And on that note, that concludes today's press conference. Thank you, everyone, for coming. Have a great afternoon.